Warren Buffett and Bill Ackman are two of the most successful investors alive today. Both are billionaires. Both have beaten the market over decades. Both have made their shareholders enormous amounts of money. But here is what most people do not realize. They use almost completely opposite strategies. And right now, in this market, one of these approaches is dramatically outperforming the other. If you understand the difference between these two strategies, and more importantly, when each one works best, you could potentially transform how you think about building wealth. So let me break down exactly what separates these two investment legends, why their approaches are so radically different, and which strategy is actually winning in today's environment. Let me start with something that happened recently that perfectly illustrates the difference between these two investors. In the last year, Warren Buffett has been doing something that shocked Wall Street. He has been selling, and not just a little bit. Berkshire Hathaway sold over $50 billion worth of Apple stock. They reduced their position by more than half. At the same time, Buffett has been letting cash pile up at Berkshire to record levels. We are talking about over $325 billion sitting in treasury bills and cash. That is more cash than the entire market capitalization of most Fortune 500 companies. Meanwhile, Bill Ackman has been doing the exact opposite. He has been aggressively deploying capital. He made a massive bet on Universal Music Group. He built a significant position in Alphabet, Google's parent company. He pushed hard into restaurant brands. He has been buying while Buffett has been selling. Now, on the surface, you might think this is just a difference in market timing. Maybe Buffett thinks the market is overvalued, and Ackman thinks it is undervalued. But it goes much deeper than that. These two investors operate with fundamentally different philosophies, different time horizons, different risk tolerances, and different definitions of what makes a great investment. Understanding these differences is not just academically interesting. It could be the key to figuring out which approach makes sense for your own portfolio. Let me break down Warren Buffett's strategy first, because it is the one most people think they understand, but actually do not. Buffett is famous for saying he looks for wonderful businesses at fair prices. But what does that actually mean in practice? A wonderful business in Buffett's framework has several specific characteristics. First, it has what he calls a moat, a durable competitive advantage that protects it from competition. This could be a brand, like Coca-Cola. It could be switching costs, like Apple's ecosystem. It could be network effects, like Visa and MasterCard. It could be cost advantages from scale. Whatever form it takes, the moat allows the business to earn above-average returns on capital year after year, without those returns getting competed away. Second, a wonderful business generates consistent free cash flow. Buffett wants companies that produce more cash than they need to reinvest in the business. This excess cash can be returned to shareholders through dividends and buybacks or deployed into new opportunities. Either way, it creates tangible value for owners. Third, and this is critical, a wonderful business has honest and capable management. Buffett is essentially entering a long-term partnership with whoever runs these companies. He needs to trust them to allocate capital wisely and treat shareholders fairly. He looks for managers who think like owners, because that is exactly what they become when Berkshire invests. Now here is the part most people miss about Buffett's strategy. He is not trying to maximize returns. He is trying to minimize risk while still compounding at acceptable rates. This is a crucial distinction. Buffett would rather earn 15% annually with near certainty than have a shot at earning 30%, with significant risk of permanent capital loss. His entire approach is built around avoiding catastrophic mistakes. As he famously says, rule number 1 is never lose money. Rule number 2 is never forget rule number 1. This obsession with capital preservation is why Buffett holds so much cash right now. He is not necessarily predicting a crash. He is simply saying he cannot find opportunities that meet his standards. He would rather earn 4 or 5% on treasury bills than invest in something where the risk-reward does not make sense. Patience is a core part of his strategy. He will wait years, even decades, for the right opportunity. Buffett's holding period is essentially forever. When he buys a business he loves, he has no intention of selling. He bought Coca-Cola in 1988 and still owns it today. He bought American Express in the 1960s and still owns it today. This extremely long time horizon changes everything about how he evaluates investments. He does not care about what the stock will do next quarter or even next year. He cares about what the business will look like in 10 or 20 years. This patience gives him a massive structural advantage. Most investors, including most professional fund managers, operate on much shorter time horizons. They have to report quarterly performance. They have to explain every position to their clients. They cannot afford to look wrong for years at a time, even if they are ultimately right. Buffett can, and that ability to wait, to ignore short-term noise, to focus entirely on long-term business value, is perhaps his greatest edge. Now let me contrast this with Bill Ackman's approach because it is almost the polar opposite in several key ways. Ackman is what Wall Street calls an activist investor. He does not just buy stocks and wait. He buys significant stakes in companies and then actively works to change them. He pushes for new management. He demands strategic shifts. He lobbies for spin-offs, restructurings, and capital returns. His basic thesis is that he can identify companies trading below their intrinsic value, not just because the market is wrong, but because management is making mistakes that he can help fix. This is a fundamentally different model than Buffett's approach. Buffett looks for great businesses with great management and then stays out of the way. Ackman looks for good businesses with fixable problems and then gets heavily involved. Buffett's edge is in identifying quality. Ackman's edge is in creating change. Ackman also runs a much more concentrated portfolio than most investors. Pershing Square typically holds only 8 to 12 positions at any given time. Each bet is massive as a percentage of the fund. This concentration amplifies returns in both directions. When Ackman is right, he is spectacularly right. When he is wrong, the losses are severe. Consider his track record. In 2020, Ackman made one of the most legendary trades in hedge fund history. As the pandemic hit, he bought credit protection on investment-grade and high-yield bonds. He spent $27 million on this hedge. Within weeks, as markets panicked, that position was worth $2.6 billion. He turned $27 million into $2.6 billion in about 3 weeks. That is a return of roughly 9,600%. At the same time, he went massively long on stocks at the March lows. He bought Hilton, Lowe's, Starbucks, and other quality companies at panic prices. Pershing Square returned 70% in 2020, one of the best years for any fund in history. But Ackman's approach also produced spectacular failures. His investment in Valeant Pharmaceuticals is perhaps the most famous. Ackman built a huge position in Valeant, believing it was a revolutionary business model in the pharmaceutical industry. He became the company's biggest cheerleader, defending it even as problems emerged. Then it all fell apart. Accounting issues, business model problems, a federal investigation. The stock collapsed from over $200 to under $10. Ackman lost approximately $4 billion. It was one of the biggest losses in hedge fund history. Similarly, His short position in Herbalife turned into a 5-year war with Ackman. Ackman was convinced Herbalife was a pyramid scheme and publicly shorted the stock. Ackman took the other side, buying a huge long position partly just to squeeze Ackman. The battle became personal and very public. Eventually, Ackman covered his short at a significant loss. He spent 5 years and enormous resources fighting a battle he ultimately lost. This brings us to a crucial difference in how these two investors think about risk. Buffett focuses on what can go wrong. He asks himself, what are all the ways I could lose money on this investment? He looks for reasons not to invest. Only if he cannot find serious flaws does he proceed. Ackman focuses on what can go right. He builds elaborate models showing what a company could be worth if everything goes according to plan. He sees the potential upside clearly and then works to make that upside happen through his activism. Neither approach is inherently better, but they produce very different risk profiles. Buffett's approach leads to fewer spectacular wins but also fewer catastrophic losses. His returns are more consistent and more predictable. Ackman's approach leads to home runs and strikeouts. His returns are much more volatile. Some years are incredible. Other years are painful. Let me give you some concrete numbers to illustrate this. Over the past 20 years, Berkshire Hathaway has compounded at roughly 10 to 11% annually. Not spectacular compared to some hedge funds in their best years, but remarkably consistent. There have been down years, but no years with catastrophic losses. The drawdowns have been manageable. Investors who held Berkshire could sleep at night. Pershing Square, over a similar period, has compounded at roughly 15 to 17% annually, higher than Buffett on average. But the ride has been much rougher. There have been years up 50% and years down 20%. Investors needed a strong stomach to stay invested through the volatile periods. Here is the key insight. Most people cannot handle volatility. They might think they can when markets are calm, but when their portfolio drops 30 or 40%, when the news is terrifying, when everyone around them is panicking, most people sell at exactly the wrong time. They lock in their losses and miss the recovery. For these investors, Buffett's approach produces better real-world results, even if the theoretical returns are lower. If you can actually hold through the volatility, if you have the temperament and the long time horizon to ride out the storms, then Ackman's approach might generate higher returns. But that is a big if. Be honest with yourself about what kind of investor you actually are, not what kind you wish you were. Now let me talk about how these two investors approach valuation differently, because this explains a lot about their different strategies. Buffett uses what he calls intrinsic value. He tries to estimate what a business is worth based on all the cash it will generate in the future, discounted back to today. If he can buy at a significant discount to this intrinsic value, he has a margin of safety. If his analysis is somewhat wrong, he might still do okay. If he is right, he does very well. Buffett's intrinsic value calculations tend to be conservative. He assumes modest growth rates. He does not project heroic improvements. He values the business as it is today, not as it might become in an optimistic scenario. This conservatism is intentional. He would rather be approximately right than precisely wrong. Ackman's valuation approach is different. He often builds sum of the parts models showing what each division of a company might be worth separately. He projects operational improvements that his activism will drive. He models what the company could be worth in a few years if management executes his recommended changes. These are not conservative projections. They are optimistic scenarios. Ackman believes in his ability to identify value others miss and to help companies realize that value through his involvement. When he is right about the opportunity and the execution, the returns are enormous. When the optimistic scenario does not materialize, the disappointment is severe. Consider how they would each look at the same company. Imagine a retailer trading at $10 billion with $50 billion in revenue, struggling with online competition, and run by a mediocre management team Buffett would probably pass entirely. The business is facing secular challenges. Management is not exceptional. There are easier ways to make money. Why fight an uphill battle? Ackman might get very interested. He would look at the real estate the company owns. He would calculate what an e-commerce spin-off might be worth. He would identify cost cuts that new management could implement. He would see that this company could be worth $20 billion if everything goes right, and he would buy a huge stake to try to make everything go right. Both approaches are valid, but they require different skills and different temperaments. Buffett's approach is more passive. Find great businesses, pay fair prices, wait. The work is mostly upfront in the selection process. After that, time does the heavy lifting. Ackman's approach is more active. The purchase is just the beginning. Then comes the real work of driving change, fighting entrenched management, navigating boards, dealing with media, managing public campaigns. It is a full-time war. Let me talk about how these strategies perform in different market environments, because this is crucial for understanding which approach might work better going forward. Buffett's strategy tends to outperform during crashes and bear markets. His emphasis on quality and valuation provides downside protection. His cash reserves allow him to buy when others are forced to sell. His long-term perspective means he does not panic and sell at the bottom. During the 2008 financial crisis, while many hedge funds blew up completely, Berkshire came through relatively intact and was able to make incredible deals. Buffett invested $5 billion in Goldman Sachs and $3 billion in General Electric at the depths of the crisis. He got preferred stock paying 10% dividends plus warrants that made him enormous profits as the stocks recovered. Those opportunities only existed because he had preserved capital while others had not. Ackman's strategy tends to outperform during bull markets and recoveries. His concentrated positions amplify gains when the market is rising. His activism unlocks value more quickly when investors are willing to pay for potential. His willingness to use leverage magnifies returns in up markets. After the March 2020 crash, Ackman's fund returned over 70%, precisely because he had concentrated, leveraged exposure to quality businesses at depressed prices. In a strong market, that concentration was a huge advantage. The question then becomes, what kind of market are we in now, and what kind of market are we heading into? This is where it gets interesting. Buffett is clearly positioning for turbulence. His massive cash position suggests he sees limited opportunity in current prices and wants to be ready for better chances ahead. When the best capital allocator in history is sitting on over $300 billion in cash rather than investing it, that tells you something. Ackman, meanwhile, is fully invested and running relatively concentrated. He is betting that the market remains constructive, that his positions work out, that his activism drives value creation. He is not positioned for a crash. Who is right? Honestly, nobody knows. Buffett has been early before. He raised cash in the late 1960s, and the market did eventually crash in '73 and '74, but not before going higher first. He could sit on cash for years before getting the opportunities he wants. Ackman's concentrated approach could continue working great if the bull market persists. Or it could lead to sharp losses if we get a significant correction. Here is what I think regular investors should take from this comparison. First, know yourself. The best strategy is one you can actually stick with through thick and thin. If you cannot handle volatility, Buffett's approach of quality businesses at fair prices with a long time horizon is probably better for you. If you have the temperament for roller coaster rides, a more concentrated approach might generate higher returns. But be honest with yourself. Most people overestimate their ability to handle losses. Second, both of these investors focus on business quality. Despite their different approaches, both Buffett and Ackman invest in good businesses. They disagree about what makes a business attractive and how actively to manage it. But neither one buys garbage. Quality matters in any investment approach. The worst performing strategies are ones that buy low-quality businesses hoping for a quick flip. That is not investing. That is gambling. Third, both investors focus on valuation. Buffett is famous for wanting to buy $1 for 50 cents. Ackman builds elaborate models to identify undervaluation. Neither one pays whatever the market is asking. They wait for prices that make sense. Too many individual investors skip this step. They buy whatever is popular at whatever price without any consideration of what they are getting for their money. Both Buffett and Ackman would tell you this is a mistake. Fourth, patience matters enormously. Buffett waits years for the right opportunities. Ackman holds positions for years while his thesis plays out. Neither one trades frequently or reacts to short-term noise. Most individual investors would dramatically improve their results simply by doing less. Every trade has costs. Every reaction to news is an opportunity to make an emotional mistake. The less you do, the better you probably perform. Let me talk about something else that differentiates these two investors: their relationship with the public and media. Buffett has carefully cultivated a folksy, accessible image. He lives in the same house in Omaha he bought in 1958. He drives himself to work. He drinks cherry Coke and eats hamburgers. His annual shareholder letters are masterpieces of clear communication that millions of people read. His annual meeting is a pilgrimage for investors worldwide. This image is genuine but also strategic. It makes Buffett seem approachable and trustworthy. Companies want to sell their businesses to him rather than private equity firms because they know he will treat employees well and preserve their legacy. His reputation itself has become a competitive advantage. Ackman is much more confrontational. He takes public positions against companies and defends them aggressively in the media. His battle with Herbalife included a 3-hour presentation laying out his case that the company was a pyramid scheme. He goes on CNBC and argues his positions passionately. He is willing to make enemies if he believes he is right. This approach has costs and benefits. The confrontation makes activism harder. Companies and their boards know that fighting Ackman means fighting him publicly. Some dig in and refuse to negotiate. Others capitulate quickly to avoid the drama. But the public nature of his campaigns also creates accountability. Once Ackman has publicly committed to a position, he cannot quietly back out without damage to his reputation. This can lead to holding positions longer than might be optimal, like with Herbalife. For individual investors watching these two, there is an important lesson. How you invest is not just about returns. It is about what kind of life you want to live. Buffett's approach allows for a calm, patient existence. He reads all day. He thinks deeply. He makes few decisions but makes them well. It is an intellectual's approach to investing. Ackman's approach is more combative. There are campaigns to run, battles to fight, media appearances to make. It is more stressful, but also more engaging for a certain type of personality. Most individual investors should probably lean toward the Buffett model simply because they have day jobs and families and cannot spend their time on activist campaigns. But if you are drawn to the more active approach, Just understand what you are signing up for. Now let me address which strategy is actually winning right now, because that is the question everyone wants answered. In the recent period, Ackman has had some spectacular wins. His pandemic trade in 2020 was legendary. His subsequent stock picks have largely performed well. Pershing Square has been one of the top-performing hedge funds over the past 5 years. However, Buffett's approach is looking increasingly wise as valuations get stretched. The AI bubble, or whatever we want to call the current tech enthusiasm, has pushed some stocks to extreme valuations. Many companies are priced as if everything goes right for the next decade. Buffett's conservatism meant he mostly avoided these potentially overvalued names. His cash position means he will be ready to buy if and when there is a correction. There is also a generational component here. Buffett is 94 years old. He is explicitly positioning Berkshire for long-term stability beyond his own involvement. The cash pile provides flexibility for his successors. The conservative positioning ensures Berkshire survives even if they make mistakes early in their tenure. He is playing an infinite game, trying to make Berkshire a permanent institution. Ackman is in his 50s. He has decades more to run money. He can afford to take more risk, recover from mistakes, and build his track record over time. His higher volatility approach makes more sense given his longer remaining runway. Let me give you my assessment of which strategy wins, and the honest answer is both win. But they win in different ways for different people in different circumstances. Buffett's strategy wins for investors who value consistency and peace of mind. It wins for people with long time horizons who want to avoid catastrophic mistakes. It wins for those who cannot devote significant time to investment research and activism. It wins in choppy, uncertain markets where capital preservation matters most. Ackman's strategy wins for investors who can tolerate volatility in pursuit of higher returns. It wins for people with the skill and time to identify catalysts and drive change. It wins for those who can remain rational when positions move against them temporarily. It wins in bull markets where concentrated bets pay off. For most regular investors, I would say Buffett's philosophy is more applicable. You do not have the time, resources, or influence to be an activist. You probably do not have the temperament to handle the volatility of a concentrated portfolio, and you likely have a long time horizon where consistency matters more than occasional spectacular years. But here is the beautiful thing. You do not have to choose 100% of one approach. You can build a core portfolio of quality businesses using Buffett's principles. Companies with moats, strong cash flows, capable management. Hold them for the long term. Ignore short-term volatility. Let compounding work for you over decades. Then, with a smaller portion of your portfolio, if you are so inclined, you can take some more concentrated positions in situations where you have genuine insight. Maybe you work in an industry and understand the dynamics better than Wall Street. Maybe you have identified a catalyst that others miss. You can take a more Ackman-like approach with this satellite portfolio. The key is knowing which strategy you are executing and why. The worst thing you can do is try to be Buffett but act like Ackman, claiming to be a long-term investor but panicking and selling during corrections. Or try to be Ackman but lack the conviction to hold through volatility. The strategy only works if you execute it consistently. Let me leave you with the key lessons from both of these legendary investors. From Buffett, remember that patience is a superpower. The ability to do nothing, to wait for the right opportunity, to ignore the noise, is enormously valuable. Most investors are too active. They trade too much, react too often, and pay too much in fees and taxes and emotional energy. Simply slowing down would improve results for most people. Also from Buffett, quality matters more than price. A wonderful business at a fair price beats a fair business at a wonderful price. The best returns come from owning excellent businesses for long periods, not from buying mediocre businesses cheap and hoping for a quick flip. From Ackman, remember that conviction matters. When you have done the work and identified a genuine opportunity, be willing to size the position meaningfully. A 0.5% position in a stock that doubles does almost nothing for your portfolio. If you are going to own something, own enough that it matters. Also from Ackman, catalysts matter. Value alone is not enough. You need a reason for the value to be recognized. Whether that is an activist campaign, a management change, a spin-off, or simply time and continued performance, something needs to close the gap between price and value. Both investors teach us that the market is not always right. Prices deviate from value constantly. The patient, disciplined investor who understands this can exploit these deviations. The investor who simply follows the crowd, buying what is popular when it is popular, will likely earn mediocre returns. Both investors also teach us that risk management is paramount. Buffett does it through diversification, quality, and cash reserves. Ackman does it through deep research, concentrated conviction, and hedging. However you do it, protecting against catastrophic loss is essential. You cannot compound wealth if you blow up. The battle between these two approaches will continue for as long as markets exist. There will be periods where Buffett's conservatism looks foolish as more aggressive investors mint money. There will be periods where Ackman's concentration looks reckless as positions go against him. But over full market cycles, both strategies have proven capable of generating excellent returns for those who execute them properly. The question is not which strategy is better in the abstract. The question is which strategy is better for you given your temperament, your resources, your time horizon, and your goals. Be honest with yourself about who you are as an investor. Pick the approach that fits you, and then execute it consistently through good times and bad. That is how real wealth is built. Because at the end of the day, the strategy that wins is the one you can actually follow. The best investment plan in the world is worthless if you abandon it during the first rough patch. Buffett and Ackman have both built fortunes not just because their strategies are good, but because they have the temperament to stick with their strategies when things get hard. Develop that same discipline. Whether you follow Buffett's path, Ackman's path, or some combination of both. That discipline, more than any specific approach, is what separates successful investors from everyone else.